four companies that have had pretty substantial rounds announced in the last couple weeks, or I guess three that have been announced officially and one that's still in discussion. This is Base Power, Hadrian, Valar Atomics, and Erebor. Starting with Base Power, this is a company that was founded by Michael Dell's son, Zach Dell. Base Power is raising $1 billion Series D at a $13 billion valuation.
Right,
That round is being led by Ribbit, Addition, Valor Equity Partners, and
right.
several other groups. I think we're also seeing previous investors in there like Altimeter and Cotu as well, including Thrive, A16Z, Lightspeed, and others. Another big deal that was announced this week was Hadrian. Hadrian is a defense tech company. We've covered a number of defense tech companies in the show previously, but they're raising about $1.4 billion. And I believe this is done at an $8 billion valuation. This round was led by JP Morgan Strategic Investment Group, and other co-leads include WCM Investment Management, Washington Harbor Partners, Valor Equity, 137, and Bailey Gifford. And then another nuclear startup that's raising capital is Valar Atomics. That's different from Valor Equity Partners. Sequoia is leading a $1 billion funding round in nuclear startup Valar Atomic. That's at a $6 billion valuation, and the company's also lined up a $200 million credit facility.
A few years ago, you wouldn't think Sean McGuire and Sequoia would lead around in a nuclear startup when it has the manufacturing requirements that they have to do. That's essentially pre-revenue. They really haven't generated any revenue yet. They're still currently in R&D and doing demonstration and pre-production. And but their investment thesis is there's an AI power crunch coming, that the traditional power grids just can't keep up with the requirements of these frontier AI models and the multi-gigawatt power that it requires. They could be selling to utilities, but I think they're actually choosing to sell to companies directly, like just direct co-located power and thermal energy. They're attracting a lot of the A+ names like Sequoia and Point72, but doing it with a very, very unusual strategy. It's also this is a very big step up from where they were just a few months ago. I think just in April of April of this year, they had a $2 billion valuation. Now they're at 6. So that's a pretty fast turnaround. And Hadrian too, they did a $1.6 billion valuation earlier this year, right around Christmas, I think. And they're also, you said 8 billion valuation, so they're basically up 4x, 5x from 7 months ago. And their lead investors, JP Morgan, as I said, but they've also got Founders Fund and Lux Capital and A16 and Altimeter. So they're attracting a lot of venture capital into the space that just hasn't happened before at really big step ups for companies that don't really have a lot of revenue yet. But obviously, this AI power crunch thesis is real.
Sort of a shifting storylines about what venture capital is financing. A lot of these companies are very capital intensive, significant amounts of money going into them before they start generating revenue. Maybe the exception there is Hadrian, which is a defense tech company and probably does have contracts lined up. And now, I don't know whether this is a reaction to sort of AI and a feeling that like physical bits are less likely to be disrupted by AI, but we're seeing really, really large, CapEx spend in AI data center infrastructure, energy infrastructure, defense tech, hardware manufacturing, all across the board. These are really CapEx intensive companies, places you didn't necessarily used to see a lot of venture jumping into. Maybe more private equity investors were putting money into sort of these types of CapEx expenditures and, leveraging debt. But now we're really seeing a ton of, venture capital going, almost I would say the majority of it, going into CapEx intensive businesses.
Hard things are not hard anymore. I guess it's become the combination of big markets, big TAMs, maybe just the fact that AI and AI powered robotics is a combination of software and hardware now. That is unusual. So maybe the VCs feel more comfortable with it, and then you've got successes with SpaceX being the perfect example now of a hardware company animated by software that's had big returns and generated wins, and so you get the herd stampede. It'll be great to see. I'm curious to see how this will play out. Like that seems to be where nuclear, defense tech, robotics, AI powered in those categories that just weren't financeable even 5 years ago. It's amazing, I think, for the industry and the category, but it'll be interesting to see how it all plays out. These valuations can hold up.
Well, one of the 4 companies that's raising a big mega round right now is a software company, I guess. And this is a company that is being founded and run by Palmer Luckey called Erebor. Erebor, for you Tolkien nerds and fans out there. That's the Misty Mountain where the dragon Smaug from The Hobbit hoards all of his loot. Plumber's running two companies at the same time. Does this seem like another entrepreneur we know, Ahmad? How many people are running multiple multi-billion-dollar companies at the same time?
That is well, it's a short list. Elon Musk and Jack Dorsey, and I'm not sure there's anyone else on that list.
Jeff Bezos now
Yes. Well,
raising
is he still at
for
Amazon, or is he totally out of Amazon? He's on to.
he's not at Amazon, but he is raising for both Blue
Oh
Origin
yes,
and his new physical
Prometheus.
the big company Prometheus as well. You're correct. Yes. But I think in the past we've sort of seen a lot of these tech banks like Silicon Valley Bank be involved in helping bank the money that's being raised for these equity rounds, but they were also involved in venture debt. I think there's a whole new class of companies that are also trying to provide debt, as we were just talking about all these capex intensive businesses. I guess one thing about capital intensive businesses is you can borrow to build out that capex if it's physical infrastructure that gets depreciated, amortized over a couple of years or so. I wonder if that's where a lot of this bank Erebor is headed. Is, hey, we're seeing a lot of these companies spend on capex. Maybe they need debt, not just equity capital, to finance those build outs.
What's interesting about Erebor too is they are a bank, and so they have their banking license now. They just got it from the OCC, and that enables them to offer FDIC insurance and take consumer deposits. So I guess that's good. But to see them at an $8 billion valuation, that's basically 80 times their ARR. Like you would never see a bank trade like that. You didn't see Silicon Valley Bank was trading at 15, 20 times earnings. Even Mercury, which is a banking provider, their valuation is south of 8 billion, and they're probably 350 to 400 million ARR. The growth in the multiple here seem startling, even though I think you're right. They've identified a need. They're going straight out with that product, and that capital that they're pulling in for these CapEx businesses is going to go and I'm sure provide a really healthy return. But just the step up in valuation and the valuation itself just seems to be a surprise. I guess what they're specializing in is these AI loans or GPU chip loans and that for these advanced manufacturers. If they know how to underwrite that, I guess that's the market they're targeting.
Yeah, well, again, I think we're seeing a whole different, type of financing that's happened in the last couple of years now, where, mega rounds of capital being spent on significant hardware infrastructure, capex intensive build outs, and a fair amount of debt, not just equity that's going into these companies as well.
Don't wanna close my eyes, don't wanna fall asleep, 'cause I miss you, Jimmy, and I don't wanna miss a thing.
All right, our last story for today is going to be about an acquisition of over $2 billion. But although that sounds great, maybe it's not always so great. Airtable is a company that's being bought by Bending Spoons for $2.25 billion. And hold your breath, that's not such a great story. The valuation of Airtable was upwards of 11 billion back around 5 years ago in the ZERP era. It was even set at maybe $4 billion in secondary trading that was happening up until just a few weeks ago.
Right.
But the overall value here is only 1.29 billion, I guess, in purchase enterprise value. And there's another $1 billion in cash on the book, so it's really an equity value of 2.25 billion.
Yeah.
That's enough to pay back a minimum 1x for some
Yeah.
of Airtable's later stage investors. Some of the early stage investors still made pretty good money, but everybody after the Series C deal, I think, is only getting 1x back. Is that a great story, Aman, or just like an okay story?
I think it's a good story. I think that's a good story. Well, here it is. It depends on, to your point, it depends on when you invested. So the exit value is, let's call it 2.25 billion. There's $1 billion in cash and then 1.25 billion in the equity value. So the enterprise value, the consideration is 2.25 billion. If you're in the A round, you did great. They were the first seed round and A rounds are way in the money. They did another round in 2018, $152 million round. That's in the money. Series C was 1.1 billion. That's the money. The Series D is going to be a little bit underwater. You may not get all your return, but really the only people who should be upset are those who invested in the E at 11.8 billion. So that's just one guy who invested that round, lost some money. Actually, it's not just one guy. It's a whole bunch of companies that invested.
That's a lot of guys,
It's
a
Silver
lot of
Lake, it's
people anyway.
Pride, it's Tiger. Oh my God, wait a second. It's Benchmark, it's Iconic. Dow Summit's Tribe. Oh my goodness. Yeah. So they had a lot of people who were along Green Oaks. There's a lot of people who are going to take a pretty.
Now, wait a second. Those folks are still getting 1x back on their money. It's not like they lost money, although they
Yeah.
certainly didn't get much of a return on their capital.
Yes, I think you're technically right. I think by the time you divvy up all the proceeds, anyone at that if the exit value is 2.25 billion, they raised around 1.8 to 2 billion overall. There may be some debt in there. So I think all the preferred investors will just about get covered, even if you were at that E round. But the early guys made money. The founders, I think, made money. One thing that you have to, it wasn't clear from the acquisition announcement, but I think what they did was they spun off their AI-ish business, Hyper Agent, into a new
That's
entity.
correct.
And the CEO will keep control of that. And maybe that's going to be, maybe that's valuable someday. And that equity piece could compensate these investors with a little bit of a kicker down the line. I think it's okay. Back in 2021, the market was overvalued. We know that. It was overpriced. Anyone who invested in that environment gets a 1x back with maybe a kicker down the line. I think it's okay. Like, move on. Silver Lake and Thrive and all these guys, they're never going to make that $11 billion number again. And so to get the money to cash out, redeploy into other investments, I think it's an okay outcome. And I think, in the case of Airtable, the founders did fine. The one thing I was a little surprised about is that there wasn't more of a competitive offer. So Bending Spoons, which that'll be our valuation corner today, they acquired the company for the 2.25 billion consideration. I'm a little surprised there wasn't like more of a private equity offer or somebody else who wanted to pay up a little bit more. The company is 480 million in ARR, growing 20% a year, profitable, and yet only got about a 3x multiple in terms of the takeout. That seems a little bit on the low side, and I'm a little surprised it wasn't a richer valuation. But that aside, I think it's an okay outcome for a company that is essentially in that SaaS pre-AI category. This is a tough place to be.
Yeah, I just wonder how durable those cash flows are. 450, 480 million, 20% growth sounds pretty good, profitable company, but I just wonder if that growth rate might collapse and whether that revenue might collapse over the next couple of years or so. SaaS shudders after Airtable's humbling sale to Italian Grim Reaper, Bending Spoons. The expectation is that a lot of software companies that are at least not shifting over to AI utilization or having agentic usage, the multiples on that revenue is collapsing pretty hard and likely to collapse even further. There may be a few companies that figure out how to, re-accelerate growth in an AI era, but certainly feels like a lot of SaaS multiples are just, never going to come back to what they were before.
Yeah, I think that's fair. It's a little bit of a negative headline, but the graveyard of SaaS companies is highly populated and growing, and there'll be a lot more companies that end up getting taken out at, whether it's Bending Spoons or someone else, 2x multiple, 3x multiple, probably going to have to cash flow. The increasing pressure in that space means you're going to have to get to profitability. Airtable was profitable, but I want to say it's only 20 to 30% EBITDA margins, and it feels like for a company like that, it should be a lot higher than that. It should be 50% plus if you manage the company to more of that mature growth stage. So which I think Bending Spoons that's probably what'll happen to it. I don't think you need that many developers and that many people to run a business like that. So it's going to trade at a multiple of 3, 4, 5 times revenue, only if they cash flow at 50% EBITDA margins. And so now you're talking about a 10x or 12x profits multiple. That's probably the fate of a lot of these SaaS companies. I agree.
I just wonder if we're going through a pretty significant transition in how people are thinking about structuring deals. Like, if we look at the differences between private equity and venture capital, private equity historically has just been equity ownership. Maybe there's some, terms and structure in there, but generally speaking, it's mostly been minority equity ownership. If you look at private equity, there's a lot of usage of debt. There's a lot of control structure.
Yes.
Sometimes there's even single owners, who are providing, a majority of that capital. I wonder if we're going to start seeing some of that, not just for the terms of acquisition, but actually the financing terms for these companies where there is more structure, there is more ownership of cash flows, not necessarily just ownership of equity.
It makes sense that there would. Your point about the durability of cash flows is a good one. If that's really in question, it is hard to finance that with debt. But I think some amount of leverage is if they end up restructuring these companies and taking a lot of the cost out to make it more profitable, that puts debt on the table. I think that's inevitable. Someone like Bending Spoons can operate and do what they did because they're trading at 10 times revenues right now. So they'll buy somebody at 3 times revenues all day. And if they can lever it up and manage the costs, then that seems like the best path forward if you're a
So
AI SaaS company.
don't you think though, like there's a rule for like where the debt is functioning as a way to pay for hard capex that has a
Yes.
value over time, and some cost of revenue is coming from the operating cost, plus depreciation cost of maintaining that infrastructure capex, and then some amount of revenue is coming from margins and cash flows, and maybe that's the equity component that gets paid back. But now I'm just not an passive equity owner. I
Right.
actually want a share of that cash flow that's in excess of the maintenance and operating budget to maintain, the debt service and the operating costs of that, capex.
Yeah, I can see that. It's not applicable to Airtable, which is all software and
Right.
very little in terms of hardware. But if you do have GPUs, if you have systems or factories or robots that have some kind of durable value, that's easier to finance that with debt because you can, as long as those things have a useful life of 4, 5, 6 years or more, you can see
Right.
how that's going to be better financed by debt, especially in this environment. I think that makes a ton of sense what you say. I think that is the right way to structure these hardware intensive businesses with a layer of debt and then equity on top.
But also, is I think a way to hedge sort of your risk about when and whether that company gets to a liquidity event, instead of just depending upon, future acquisition value, whether that's, an IPO or an M&A sale. You might just say, well, hey, I want a piece of the cash flows, at least the portion that's contributing to, operating profit. I want that payback, as soon as possible.
Yeah.
Take some of my risk off the table. If I can at least get my principal back in terms of like almost dividend style cash flow payments.
I think that makes sense. That's how private equity firms typically do it. And it makes sense that that model will apply to these late stage SaaS companies now.